Good afternoon. Thank you for being here and thank you for having me. Again, my name is Doug Sockman. I am with Skylight Financial Group here in downtown Cleveland. Before I begin, I wanted to start with a little story. How many of you, or has anybody heard of the little boy that wanted $100? Anybody hear this story? There was a little boy that wanted $100. And he wanted $100 so badly that he decided to pray for the $100. Well, when his prayers weren't answered, he said, you know what? I'll write God a note. So he wrote a note, Dear God, if you would send me $100, I would be very, very thankful. Can you please do this for me? Folds up the letter, puts it in an envelope, and addresses it to God, USA. Well, the postmaster gets a hold of this and gets a chuckle and says, this is something the president has to see. So it goes across the president of the United States, Obama's office. He sees it, forwards it to his secretary and says, hey, send this guy $10, he'll be ecstatic. So about a week later, the little boy gets the mail, there's an envelope in there, opens it up, and what's inside? $10. He is ecstatic. So ecstatic, in fact, that he decides to write God a thank you note. So he writes a note, Dear God, thank you so much for sending me the $100. I am so happy. I did notice, though, for some reason, you sent the money through Washington, D.C., and they withheld $90 in taxes. I apologize. That's about as good as my jokes will get here this afternoon, so you might be in for a long 45 minutes. Again, thank you for being here. As a certified financial planner with Skylight, I'm continually asked questions relating to things like, when I retire, how much money can I spend for my investments? What rate of return do I need to average? Or how do I make sure that my dollars outpace inflation? How long is my money going to last? How do I shelter myself from the highs and lows of the market? Case in point, 2008. How do I make sure that I don't lose 20, 30, 40% of my portfolio when I don't have the time to make it up? These are the questions that, as an advisor, I'm continually advising people on the questions they should be asking themselves and how to find answers to that. So here in our brief session together, it was my hope to touch on some of those questions that you might be asking yourselves as you hone in on retirement, and how do you find some of those answers so that you can start to formulate a game plan. Fidelity did a study a few years ago, and they surveyed about 2,000 people age 50 or older. And what was interesting with this study is there was really one key question to it. And the question was, they asked all the participants, how or what withdrawal rate can you take each year from your investments when you retire? By withdrawal rate, I mean, let's say you had $100,000, a 10% withdrawal rate would mean I can take $10,000 per year from my $100,000. Anybody have an idea as to what was the most common answer? And by the way, these were all educated individuals. What was the common response you think that people answered to? What is the average withdrawal rate you can use?
Now, you want the one that's not the real one.
I want whatever one you want to give me.
I would have said 20.
20%?
Yeah, but it's really only about 5.
Yeah. It was about 9 to 10% was the average response. So on $100,000, that's taking $10,000, $9,000 per year. And you hit the nail on the head. The withdrawal rate that you should be thinking about is much lower than that. In our industry, a general rule of thumb is a 4 to 5% withdrawal rate. So for a $100,000 account, that's pulling $4,000 to $5,000 per year. While it doesn't sound like a lot, when you start doubling that up and you back test against varying market conditions, you're almost assured of running out of money, especially if you're going to make it to life expectancy. So that was the key factor there. One of the things I want to preface with our discussion here today is a lot of the things I'm going to talk about are general. If you can use them as general guidelines or general benchmarks. It's not a one-size-fits-all. I understand all of you have different circumstances, different financial means, different risk tolerances. So I have to put on my compliance hat to satisfy the compliance department that, again, everything that we're talking about, please don't take it literal. Use it as maybe a guideline. So when you think about this study that I talked about with Fidelity and about a withdrawal rate and using 4 to 5%, when you start planning your retirement, I think that's a good starting point. That if you take 4 to 5% each year from your investments, you can give yourself a raise each year for inflation on top of that. Again, when you backtest that over 30, 40, 50-year time frames, you give yourself the highest probability of your investments lasting longer than you do. So one of the other questions is, well, rate of return. What rate of return can I assume growth-wise on my investments? So again, when you start surveying people, some people still even to this day will say 8, 9, 10%. That's pretty aggressive. For planning purposes, especially as you start zeroing in on retirement, you should probably be in the neighborhood of 6 to 7%. That doesn't mean every investment you own is only earning 6 to 7, but when you blend everything together. For example, when you retire, you probably don't want to have all of your money in the stock market, because when another 2008 comes, it goes down. So you typically will have safer bond fixed income type investments. That's going to bring your average rate of return down. And you need more of that in retirement versus less. So if you use a 6 to 7% rate of return, I think under today's environment, that's a fair starting point. And again, if we look over the last decade, so we've had a pretty bad market or flat market. If you take a balanced fund, which is about 50 to 60% stocks and about 40 to 50% bonds, and you backtest that over the last 10 years, net of fees, a good balanced fund did about 7.5 to 9%. So using 6 to 7 as your starting point, again, I think is a fair or reasonable approach. Now, one thing you want to be aware of is some people say, okay, well, why don't I just go get in this balanced fund that is a 60-40 split, and that is what I'll use to provide income. The problem with that is that the stocks in there will go down in a down market, and there typically aren't enough bonds to even keep you up to even, that you could be drawing in a down market or losing money as you take withdrawals. So one of the things we'll talk about is as you start looking at your investments, looking at different pools so that you have what I call your rainy day money, the money that you can withdraw from safer investments to get you through bad markets. That leads to mix of investments. That's another question. So what rate of return can I assume that I'm going to average? Now, how do I allocate my investments? What should be my percentages? Again, backtesting this over decades and decades through good and bad times. Some people, I would say most people are probably too conservative or too aggressive when they get to retirement. They're so aggressive because they think they have to outpace inflation, or they didn't make the right changes, or they're so conservative because they're afraid I can't lose money because I'm in retirement. Realizing that on your first day of retirement, there are dollars in there you won't spend for 15 or 20 years. That money can be invested differently than the money you're spending today. So if you are too conservative with your investment mix, what creeps up on you over time? Inflation, right? Your buying power. About every 17 to 20 years, what you're doing today will cost double. So you'll go through that at least once in retirement, right? If you retire at 65, maybe once you go through and food, clothing, shelter, all of those types of things are going to double in price. So you need to make sure you're outpacing that. So back to a general mix of investments. Historically, if you have a 60% equity base and a 40% bond or fixed income base, that gives you enough momentum to outpace inflation, but doesn't put you too far out on the tree limb where you're at the mercy of the stock market.
What was that breakdown again?
60-40, 60% equities, stocks, stock mutual funds, 40% fixed income or bonds. When you start drifting to 50-50, again, depending on the time frame you're looking at, you can run some risk of not getting a high enough rate of return to outpace inflation long term.
Do you believe that any of that money should be in CD, money markets, just for immediate cash, or at least to protect yourself from a catastrophic market fall.
Definitely. And the reason for that is where a lot of people got burned in 2008. Money wasn't only fleeing stocks, it was fleeing what else? Bonds. Bond funds. People were invested in bond funds and never thought they could lose money. You can lose money in a bond fund because there's a price. There's a supply and demand factor. Everybody was fleeing bond funds and going to cash. And so some of the bond funds lost 10%, 12%. So with that, yes, you should have typically a year or two's worth of expenses in something that's guaranteed that you cannot lose money. The bond market will come back quicker than the stock market because it won't fall as far down. And then you use the bonds to get you through till the market can come back. I mean, think back in 2009, March of 2009. The market was at its low. Basically, the S&P 500 and the Dow lost half. So everybody's running for the exits. Nobody wants to be in equities. This time's different. The market's not coming back. Well, what has happened? Fast forward to today. We're to all-time highs. The S&P has finally burst through the 1565 today. It might end the quarter at an all-time high. So you need patience with the market, but you also need time, 5-7 years, to get through some of these bad cycles. But yes, if you look at your investments in maybe 3 pots, having some fixed guaranteed, where you're not going to get a whole lot of interest today, but you can't lose principal. Then your next layer are your fixed income investments, bonds, bond funds, and then you get into equities. When you look at resources, and as you start thinking about planning for yourselves, one of the areas that's great if you want to do it yourself, Fidelity, which you've probably all heard of, they have a great website that has retirement calculators on it, where you can utilize and start playing with some of these numbers that I'm talking about to get or gauge your roadmap. Hey, here's what I have. Here's what's going to come in the door. What might that look like? So I would highly advise you that if you're looking for resources on your own, go to Fidelity's website, and they've got a number of different retirement calculators. So when we look at assumptions, assumptions are very critical. There's a large margin of error with them, but when we start talking about the inputs that you're going to make to that, it'll ask things like inflation. What do we want inflation to look like? Inflation has averaged over the last 80 to 100 years about 3.1%. So if you want to play the long-term law of averages, 3.1 might be a good starting point. It's been lower in recent years, but if we throw in a decade like the 70s, heaven forbid that happens again, it brings that number up quickly. So it's going to ask you for inflation. It'll ask you for a rate of return, which we talked about. 6, I wouldn't assume any higher than 7% growth rate. It'll ask you things like life expectancy. I wish we all had stamped on our wrist somewhere kind of our drop dead date, but we don't. So it makes planning very hard when it comes to, well, how long do my assets need to last? That's back to where I had mentioned earlier, a 4 to 5% withdrawal rate. I don't want to say it lasts indefinitely, but we need to get you beyond life expectancy. And that's one of the mistakes I think our industry makes, not only at consumers, but the advisors, is the assumption around life expectancy. If you study life expectancy, anybody know what life expectancy was in 1900?
50.
Great, 48. So you're right there. So 50 years later, at 1950, life expectancy was 60. When you look at those times, when they say you were worked to death, you literally were. You didn't have to worry about retirement. Now we take from 50 to the present day, life expectancy today is about 78 to 80. If you take those upward percentage trends each 50 years, that says that by 2050, life expectancy is 110. Now, I'm not here to debate life expectancy and whether we're living to 110, but what I will share with you is if you're using 80 as your number, I don't know that you're leaving yourself enough margin for error. So when you start talking about when we run our financial plans, we run them out to at least age 90. I actually run all my clients to age 100. What that does is it leaves me a margin for error that if I don't hit the mark on my rate of return, I've had your assets lasting longer than they might need to. If I haven't hit the right rate of return and I'm off on inflation, I've left a little longer period to withdraw from my assets. The message today with this is this is not an exact science, it's an art. So again, I'm giving you some guidelines and some general parameters. So we talked about inflation, 3.31, rate of return of 6 to 7, depending on your risk tolerance. And then finally, life expectancy, probably using an age 90 factor. If you're married or have significant others, remember there are 2 of you. So that ups the probability that one of you makes it longer than today's life expectancy. When we look at other resources you have, obviously here at the Plain Dealer, I'm somewhat versed through Teresa, and I know you have a pension for those of you that qualified back in the day. That was frozen, so there'll be some fixed income there. But really the piece you control is the 401k. And looking at your fund options and what you have available to you, the target date funds are great for those that want the turnkey, want to be the passive investor. Because what's nice about the target date funds is they automatically dial down the equity or stock market exposure as you get closer to that age. For example, the 2015 fund that you have in there, I couldn't pull that exact fund up, but a general 2015 fund has about 60% stocks or stock mutual funds and 40% bonds. Remember the number we talked about earlier? A 2020 fund is going to have about 70% stock market, 30% fixed income or bond. Now, word of caution. If you leave here, retire, and you leave your money in the target date fund, again, if that's your only pool of money, that money or that fund will lose money in a down market, like it did in 08. Now, it won't go down as drastically, but you could see a 15% loss, 18% loss if we redo 08. And a lot of people aren't aware of that. So if you needed money, if I'm retired and I need $5,000 tomorrow, and the market's where it was in 09, to go take out that $5,000, what am I sacrificing if I take it from the target date fund? I'm sacrificing the loss, right? I had to take more shares out to get me the 5 because a year or 2 prior, that 5,000 was actually worth maybe 6,500 or 6,000. So that's the big word of caution where I think sometimes in a down market people can get burned is they're not taking that into account. They're like, well, yeah, I have the right mix. Well, it's the right mix longer term, but if you need money today, it's back to you need that rainy day or cushion to get you through if the stock and bond market are down. So utilizing the 401k, obviously it's great because money goes in pre-tax. You can put it into the fund choices or use the target date type fund. Now when you go to use it, you pay taxes on that. When people retire, you're left with options. You can leave the money in the 401k and utilize those choices. You can roll it to an IRA, which you self-direct, or you can roll it to an IRA or IRAs and utilize an advisor. There's not a right answer. It's what works for you. If you are going to leave the money in the 401k, the one issue or 2 issues there would be, number one, you're limited on choices as far as investments. Are you getting top-notch performance relative to peer groups? But when you go to take a withdrawal from a 401k, they have to withhold a mandatory 20%. So for those of you that aren't paying 20% in taxes, why give the government extra money? So a lot of times people will roll their 401k to an IRA, then they can dictate what they want withheld for taxes when they take a distribution. So if your money's sitting in the IRA and your accountant or you figure out, hey, I only need to withhold 10% and I'm not going to owe at the end of the year, then through the IRA, when you sign your form to take the distribution, they're only withholding 10. 401k, they have to take 20. So if you're going to self-direct it, again, back to a general resource that I'll recommend is Fidelity. Fidelity has a lot of different funds. You can start to build your different pools to get that 60-40 mix, to have some safer money, and you control it.
What about the, I heard of the Roth fund, where that, is that another option?
A Roth?
Yeah, isn't that where they already take the taxes out?
Exactly. it gets a little confusing tax-wise. In a 401k, right, money goes in typically pre-tax, not taxed, grows each year. When you go to use it, it's 100% taxable. Some plans offer a Roth 401k. The money goes in after it's taxed, and then when you pull it out, it's tax-free. You can also set up a Roth IRA, provided you're within certain guidelines, where you take after-tax money, put it in an investment, and then it grows tax-deferred, and you pull it out tax-free. Confuse matters more, then you can do what's called a Roth conversion, where you could take your 401k or a piece of your IRA and move it to a Roth. But to do that, you have to pay what? Taxes. So before you start jumping, hey, I want to go get my money tax-free, realize the cost factor as to what are you outlaying in taxes to get it there, and that typically boils down to your tax bracket. You don't want to put yourself in a higher tax bracket making that conversion to have tax-free money down the road. The break even is just way too far out. Did that answer your question?
Doug, you were saying with the 60-40 with the stocks and the bonds. Is there a industry standard on how much you should have in a typical 401k, which is taxable for retirement, and then how much money you should be, maybe creating a second account with a Roth, figuring that tax rates may go up, and you might, it's better to pay the taxes on the money now at say 20% as opposed to possibly 40% in the future. Is there? I haven't seen an equation. I mean, is it 100 nothing? Is it 80-20? Is it?
Yeah, the question is, for those that didn't hear, is there a percentage or a dollar amount you should have in 401ks versus other types of instruments, such as a Roth, an IRA, a non-IRA? And the answer is, it depends. Everybody's different. I think as you're planning and if you have some time, yes, you don't want to put all of your money in the 401k. The reason for that is because you're at the mercy of then the tax code. When you go to take it out, it's all taxable. Your pension's going to be taxable, and your Social Security, believe it or not, can be taxable, depending on your income. If you can build up a tax-free bucket, so we talk about them as buckets. 401k is taxable, Roth IRA, not taxable. If you're eligible to make Roth contributions and you have some time, yes, set up a Roth account, funnel some money to the Roth. That money will be tax-free. That can offset some of the taxes from the 401k down the road. Again, general rules of thumb, there's not an exact science to it. There's not a formula. When people start asking, okay, I want to save X amount of dollars per year or per month, if there is a match in your 401k, you certainly want to put into that because that's free money. But then it's a balancing act from there. I know you don't have a match here, so I probably shouldn't have said that.
See, that's what always upset my mother, because when she was collecting Social Security, that money was already taxed when it went in, and then they're like double dipping. Then when you go to, use it, it's taxed again. So
I hear it every day. I mean, for those of you that don't know, if you have a modified adjusted gross income, fancy word, what does that mean? When you're retired, if you add up so take your Social Security benefits, again, if you have a significant other, partner, spouse, take that money, right? If you cut it in half, Social Security, add in pensions and any taxable 401k, IRA distributions, if that number's over $44,000, and it might have changed a little bit, but roughly over $44,000, about 85% of your Social Security is now taxable. So to your point, it was a tax, and now you're taxed on it because the government deems you as well off. So how do you circumvent that? Money coming from a Roth IRA is not taxable. So maybe you pull up to a certain limit, Social Security, pension, 401k, and when you start hitting the threshold, then you're starting to use a tax-advantaged account like a Roth IRA. Municipal bond interest doesn't count in that. If you have cash value life insurance, that's another one.
Yeah, one of the most pressing questions I keep hearing proposed is, do we take a lump sum or do we take payments?
For
Severance. Say you get, you've been around a long time and you get a year with your vacation. Let's call it 65 gross. What do you do?
Great question. I would look at if you're a single taxpayer filing single, or are you married filing jointly. What you want to look at is are the brackets, and does that extra amount kick you into a higher bracket? So let's say married filing jointly, the 15% bracket maxes out at about $70,000 of taxable income. So you get your gross incomes, you subtract out what you put in your 401k, you subtract out capital losses up to $3,000 if you have them, you take your deductions, and you take your exemptions. So you're at your taxable income. If that number is 70 roughly or above, you're falling into the 25% bracket. So you have to look at, okay, let's say this year my taxable income's 60, and now I'm getting a $65,000 severance, and they're saying, do I want it all now or do I want some next year? I would take as much as I could now to max out the 15, which would be another 10,000. Take the rest the next year, assuming I don't have any other income or it's lower, I'm keeping all my money at a 15% rate versus a 25. Now I know that's confusing. Did I lose you there?
Yeah.
Please ask questions.
I think our only option is either going to be to take it all, or or weekly salary. Like, is that right?
Yes.
Monthly, whatever. Okay.
Yeah, then all it boils down to is year over year, right? A calendar year is what matters. So if it's at the end of the year, if we're talking about getting everything in November versus getting it monthly, and now it's carrying over into 2014, that's where that strategy could help you. Pay less in taxes. Other questions relating to the tax?
Well, so and if you're investing the money, if you're trying to invest the money and do it prudently, wouldn't you be better off just taking the lump sum and making the prudent investment and letting that money grow?
I like your
You're gonna
thinking.
get paid, you're going to pay the taxes regardless.
I like your thinking, but let's look, for example, let's say I'm just using round figures. Let's say it's $100,000 is the number. Let's say, so there's $100,000. The difference between 25% bracket and 10% bracket, or I'm sorry, 15% is 10%.
Right.
10% of 100,000 is $10,000. So what you're now saying is if you took all that and I'm going to go invest it, your break even, you have to earn 10% on your investments over the next year, guaranteed, to make up what you just paid in taxes. So you have the right thought process. The problem is the tax hit in the short term is so great, there's not an investment that anybody can show you that's going to guarantee you make up the 10 or put yourself ahead versus paying at a 15% rate, let's say, a year later.
Because you're saying you have to make up that 10% in one calendar.
Exactly. Versus if you were getting it over month by month, you could be taking that net monthly paycheck, investing it, and still keep yourself in the 15% bracket in my example.
But you can't collect unemployment if you're still tethered to the company. That's the thing, is whether or not you want, that's a big question here too, is that, if you're still tethered, you cannot collect the unemployment. So that investment, that money has got to last you because you're not getting any supplemental.
Correct.
In the interim. But can you income average? You used to be able to, say Mark, you take the big hit this year, and say, for instance, I haven't been able to find a job, so my income goes from whoop down to. You used to be able to income tax average. Can you still do that to try to help even that out?
As far as can you income average, I'm not aware of that. I don't know that you can still do that.
You used to be able to do a long time.
Yeah, I would check with a CPA. I don't know that still exists, but I'm probably not a good one to ask on that. So back to when we talk about resources, and we talked a little bit about your 401ks, and the big question is, well, what do I do with that money? Where do I keep it? We talked about leaving it there and using the funds you have, and just realizing that you're subject to the mandatory 20% withholding. Utilize an IRA that you're going to direct and start building your pool, or you utilize an advisor. So again, I had shared with you earlier, there's not a right answer. But I think if you look to Fidelity, for example, and start looking at their retirement calculators, I think you can get a good framework as far as, okay, what's this money look like? How long is it going to last? And then do I want to utilize some of their investments to get me there? I've given you kind of the 50,000-foot view of some of the questions you should be asking, some of the numbers you might use as far as assumptions. I've talked a little bit about growth rate, inflation, withdrawal rate. What I'd really like to do is to make this the best use of your time is you've already started asking some good questions. What other questions do you have that would be helpful, or how can I arm you with more information so you walk out of here feeling like this was a good 45 minutes?
What's your feeling on long-term care insurance?
Questions, long-term care insurance. Great question. Long-term care insurance, when you look at the odds, so according to AARP, age 65 or older, there's about a 1 in 3 chance, once you're 65 or older, that you will need some sort of care that's not covered by your health plan. And it's only covered by Medicaid if you've spent down your assets. So when you take a couple, if you remember, what is it, 7th or 8th grade fractions, 1/3 plus 1/3 equals 2/3. There's a 67%, 68% chance that a couple, one person, will need some care that's going to come out of pocket. So it's a very real issue. I think it's the biggest gap that retirees face, that a lot of times people just bury their head in the sand and do nothing. What are your options? Your options are, you have enough money today that you can carve off a piece and you can't use it unless there's some sort of long-term care expense. We're talking about some big numbers. The average cost in Northeast Ohio is roughly $70,000 to $80,000 a year, and that's going up at about a 7% clip. The average stay is 3.1 years. So in today's dollars, in round figures, we're talking about $240,000, $250,000 need. It's huge. So to self-insure, you have to be able to carve off for each of you $500,000. Most people can't do that. So now you're left with two options. You bury your head in the sand and hope you're not one of the statistics, or you buy coverage. When you look at buying coverage, again, this is just a general guideline. Everybody's different and has different needs and wants. If you have 100 or 150,000 of investment assets, you probably shouldn't go spend thousands of dollars buying long-term care. The reason for that is the state of Ohio allows the healthy spouse to keep roughly $100,000 of assets. So you don't have to burn through everything. So when we're talking the difference, if you had 150, you can keep the house. Okay, you'd have to spend down to 100. You're not leaving the spouse with nothing. Again, general parameters, general guidelines. When people have about 250,000 of investment assets and up, then we start talking about long-term care insurance. The earlier you get it, typically the better rate, and it's less expensive. But it is not cheap. It's expensive.
Also, isn't the industry sort of famous for not paying on claims?
Some, it's just like anything else. If you're going to invest in a company, you're researching that company, and you're investing in it for a reason. It's no different with insurance. When you're going to pick an insurance carrier, they better have great ratings, terrific ratings, strong financials, good reputation, and a good, well-priced product.
So if you're single and you don't have that spouse that can keep the house and the $100,000, what happens to you if you have to spend it?
That's a good question. I'm not sure what happens as far as the state, if you're allowed as a single person to keep that or not. I'd have to check with our estate planning group.
You've got to spend it down to about $1,800. I mean, before you can get into Medicaid.
By the way, if any of you, I should have said this at the beginning, if you have questions that you want to ask either afterward or you want to write it down on a note card or something and give it to Teresa, and I'll get back to you with an answer. If there's something I can't answer today or didn't have a chance to, give me some time, I'll get back to you with an answer on some of these questions.
Since we're in the long-term care area, what do they consider the assets that would contribute to the 150,000 or 250,000 limit? Do they consider what you might be getting in pension? Are they considering Social Security? What factors into it?
Yeah, the question is what do they consider as far as what you can keep, what assets count for that long-term care formula? there are two formulas. There's an income formula. What are you bringing in as far as pension and fixed income? And then there's the asset side. The assets are typically your investments. So stocks, bonds, mutual funds, IRAs, 401ks, all of your investment assets outside of your home. They can't take the residence from you. Good questions. What other, Teresa?
One that someone asked me who couldn't be here, and you talked earlier about the 401k. If someone gets laid off or decides to leave, is there a period of time that they have to move their money out of the 401k before like any kind of administrative fees kick in? And what would you recommend as far as a time frame?
Did everybody hear the question was, is there a time frame or what's the rule of thumb if you leave? How long should your 401k dollars stay there, or are you subject to certain things? I believe it's plan specific. So some plans, I mean, their fees are all different, so that's written into the plan and the type of investments. Some, there's a mandatory, if you have a certain balance or lower, you have to roll it out or they're going to cut you a check. But most often, there's not any issue. You leave it there and you can withdraw from it and utilize it. Again, unless the plan document says something different. But again, I would check with your plan sponsor or plan provider to get the specifics because they can be written differently.
Should we be concerned that they changed our 401k fidelity plan so that our money is now no longer in actual mutual funds?
Yeah, great question. Your plan went to these target date funds, these funds that are conglomerates of stuff, and they're very tough to analyze, especially for somebody like me. Why a lot of the companies are doing this is because they want the risk. They don't want you going back saying, hey, you offered me this fund and it lost 45%, and I want to hold you accountable. Those laws are starting to change. I'm not an expert in that area, but that's what's coming down the pike. So they're going to these target date funds, these groupings, which are okay. They're great for the passive investor that, hey, I put the money in there and I don't really have to worry about it. From a comparison standpoint, from a performance standpoint, you could be lacking some. Most people, when they retire or separate from service, are rolling their money to an IRA. Then the question is just, do they want to manage it or are they having an advisor help? I mean, I rarely have somebody that has left their money in the 401k. Why be tied to those small number of funds or those small parameters versus, hey, I have, 26,000 or so mutual funds out there. I can go to that whole universe and pick something that works for me, and I can see how it's doing against its peers. I can look under the hood, so to speak.
I inquired about how I could get the 401k money out of those and into other fidelity funds, and they said that I could do that within the plan up to a certain amount of money. Would you recommend that some of us go ahead now and just start shifting that money into fidelity plans in a separate IRA?
So I'm not sure. So what the plan allows you to take money and utilize choices outside of the general choices you have?
Right, but you'd have to set up a separate IRA now, and I don't know I didn't pursue this far enough to figure out what percentage we can take out, but a Fidelity representative said, yes, I can set that up for you. We can start taking some of that money out of those non-funds.
So the question was, can you pull money out of your choices at Fidelity, or the number of choices you have here at the plain dealer, and move it to something else in Fidelity? I believe what your plan must allow, and I would double check, is an in-service withdrawal. An in-service withdrawal is the language in your plan document that allows you, while you're actively working, to take money from your 401k and roll it to an IRA. No tax consequence. You could use Fidelity, you could use Vanguard, you can use whoever you want. So I think that's the first question. I'm not aware of that. I would find out if you're eligible to do an in-service withdrawal, when can you do it, is there an age restriction, and what percent can you take out? And yes, I would take advantage of that. You can go set up your IRA with any investment firm you want and have those dollars go in with no tax consequence, and now you're opening yourself up to all the different choices that are out there. That's a great, not a lot of plans offer that, so if you can do the in-service, that's nice they're allowing you to do that.
And I get one more question over there.
A question over here?
The 60/40 formula, when do you advise doing that? Like, on the day you retire, before, after?
Great question. The question is with a 60-40 split, the general rule that I threw out for retirement, typically you want to start getting into that mix probably about the 5-year mark before retirement. Because that's, again, where most people, they don't look at it, and they're way too aggressive, and now I'm going to retire next year, and what inevitably happens? The market goes the wrong direction. So I think at the 5-year mark, you're certainly starting to look to dial down the risk and get to that 60-40 split.
I'm 60, soon to be 61. If I were to get laid off, would you recommend taking the pension right away, given that with our membership going way down, that there might not be as much money going in, although supposedly federal law says you're entitled to it, but they could also dump it on the pension guarantee board, in which case you'd end up getting a lot less. So what would be the good strategy?
Yeah, the question was with the pension, if you're 60, 58 or whatever, if you can take it immediately, should you? That's a loaded question. There are a lot of variables there. Every year you wait, you get a little higher payout. So the first question is do you need the money? Then the second question is you're starting to talk about life expectancy. You're playing the odds there. Because all they're doing with the pension, just like Social Security, they're giving you a larger payment over a shorter period, or they're giving you a smaller payment over a longer. So back to, we don't know how long we're going to live. There are some issues with, okay, is this pension strong enough? Does it default and then then you're only getting, let's say, 60 cents on the dollar? There are a lot of variables there. I hate to give you a right or wrong answer. I think it depends on the given situation as far as what are your needs. If you need the money, then you're obviously going to take it. If maybe you don't need the money, maybe you prolong it. But again, you're starting to talk about longevity and how long do you think you're going to live. And so I wish I could give you a more specific answer, but those are at least some things to talk through.